Welcome back, my beautiful friends. You're listening to A Moment of Zen right here on 710 WOR, the voice of New York, iHeartRadio. I'm your host, Zen Sams. Up next in our Business and Buzz segment, brought to you by Revere Securities, we are joined by our good friend and returning contributor, Kyle Wool, non executive chairman at Revere Securities. And tonight, on this very special New Year's Eve, we are chatting all about the money moves you should be making to set yourself up for financial success in 2023. Now, the past year has been marked by record high inflation and multiple interest rate hikes. As the Fed attempts to rein in inflation by raising interest rates, there's a strong possibility that the economy teeters towards a recession in the coming months. So, if you're concerned about the economy, guess what? You're not alone. In fact, consumer sentiment about the economy has hit historic lows. Though personal finance advice is unlikely to save you from inflation or a market downturn, Kyle is going to come on to share some personal finance tasks and tips to help you save at least some money and to plan for the future. Now, when it comes to getting your finances in order, you'll want to consider how rising interest rates affect how much interest you pay on your debt. Now, when the Fed increases the federal funds rate, it does alter the interest rate on interbank lending. And this in turn affects how much interest you pay on your debt. It's truly all very much connected. Now, here to chat 2023 investments and coming out winning is our top trending financial literacy segment. And my dear friend and expert at hand, Kyle Wool. Welcome to the show, superstar.
Thanks for having me, Zen, and Happy New Year.
Happy New Year. So, Kyle, if anyone knows how to build wealth, it is you. You have spent your entire career investing for people and making them very, very wealthy. You're a smart and very successful business person. When it comes to getting your finances in order, I'd say that one would want to consider how rising interest rates affect how much interest we pay on our debt. And when the Fed increases the interest rate, like I said earlier, this in turn is tied to credit cards APRs. They are tied to the federal funds rate, but more so, even with investments tied to our actual money invested in the capital markets. It all goes hand in glove. What advice do you have going into 2023 to hedge against this insane inflation when investing?
Yeah, I think you make some great points, Zen. And I do think the most important thing that we need to think about is the serviceable debt that each family has. What I mean by serviceable debt, what is the debt that you have to pay on a monthly basis, right? And going back to what you just said, your credit card debt, that's one of them. That will move up as interest rates move up. Also, if you have a HELOC, a home equity loan, that has also moved up substantially to probably 6, 7, even 8%, depending on your credit rating. Other things that you have to look at, if you have a 7-year arm or a 5-year arm or a 9-year arm, depending on where you are in that gestation period, your monthly mortgage payment could be going up substantially from where you locked it in just a few short years ago. So I think those are the things you need to focus on first. And secondly, you have to look at your investment portfolio. And you want to make sure that you're investing into companies that are going to do well in a higher interest rate environment. Now, as rates go up quickly, certain sectors like technology have been affected. But when you look at the traditional commercial banks like Wells Fargo, the Bank of America, these are places where now they haven't been able to make money on mortgages or make money on money markets in a long time. So those kind of investments will probably do quite well in this economy. So these are the kind of macro themes we need to look at. But I would say the first and most important thing is to make sure the debt that you have is serviceable, and all of a sudden that you don't have 7 or 8% on a monthly basis that you need to start paying to keep yourself in the black.
That's some great advice. Great advice. And yeah, the bottom line, I mean, that's where the Federal Reserve System comes in. Its primary function really right now is to maintain a low inflation rate and unemployment rate in the US, which it does by controlling the federal funds rate. By increasing the federal funds rate, the Fed makes it more expensive for banks and therefore consumers and businesses to borrow money. So to your point, for consumers, higher interest rates mean it's more expensive to buy big ticket items that are typically purchased with credit, such as homes, automobiles, furnitures, and large appliances. So you do have to make sure that your debt is serviceable and that you are thinking long-term strategically. Let's flip back to your wheelhouse. So higher interest rates may help curb soaring prices, but it also increases the cost of borrowing, which can make everyday financial products more expensive, like mortgages, personal loans, and credit cards. And given the current economic outlook and interest rate environment, saving money and paying down high interest debt have become much more appealing. But right now, there are no signs rates will be dropping anytime soon. And the Fed actually says it's going to continue to rate hikes in 2023. So even if the economic outlook suddenly shifts, it's always a good idea to focus on the fundamentals that you put on firm financial footing. What should those fundamentals be, in your opinion?
Well, I think we have to look at where we are within the rate cycle, right? And I would say taking inflation and controlling inflation is always like a two-headed dragon. You have the fiscal policy and you have the monetary policy. On the monetary side, we've raised interest rates quite a bit in the last 12 months. On the fiscal side, I think we need to curb spending. And hopefully with the new Congress, we will start to curb some spending. So knowing that we're probably at the last stages, hopefully, of raising interest rates, you can start to factor going forward. So if you do want to dive into a mortgage, may not be the worst time to dive into a mortgage, because even though they have moved so much, then historically they're not that high. I remember when I was a young child, and I'm a little bit older than you, I remember in 1980 our parents' mortgages were 20%. You were getting 18% on CDs. Now your money markets have gone from zero to you're getting an actual return on your money markets. If you want to buy the 1-year US Treasury, you might get 3.5%. So there's things you can do with your cash right now that you couldn't really do for the last few years. If you left your money in the money market, you're getting a 0% return. If you're looking at 1-year Treasuries, it wasn't even worth putting the money in there. So there are conservative ways to put your conservative places to put your money. And I would say just pay very close attention. I think we're at the end of the rate hike cycle. I wouldn't be surprised if the economy continues to trudge along a year from now or even 18 months from now if you see a rate cut. But I don't really think we're going to have any substantial rate hikes. So knowing that, yourself and also Fortune 500 companies can begin to plan that out over the next 12 to 18 months, which is very important. 6 months ago, we didn't know if it was 1980, like Chairman Volcker, they were going to 18 to 20%. Nobody really knew. But I think we're pretty comfortable right now. That is inflation under control? No. But is it much closer to being under control? Yes.
I love the way you put that. I mean, you said at the onset of answering this question, you may be a bit older than me, but you appeal to that young investor frame of mind, even though you have that old school mentality and cater very much to the baby booming market. But you have this approach that you could speak Gen Z language, you could speak millennial language. And so I think that financial literacy plays a huge part in why your business is so successful. But let's talk about the famous question. So for wealth managers, do you believe you can outperform the market, right? So according to Spiva US scorecard, Kyle, 92% of large cap money managers, 94% of mid cap managers, and 91% of small cap managers failed. I repeat, they failed to exceed their benchmarks in market performance over a 15-year period ending in 2017. So these statistics are slightly dated, but again, we're looking at a 15-year period, right? So someone like yourself who knows the facts will say, that it's highly unlikely to outperform the market. And that's why you use a strategic approach. Talk to me about your approach.
Well, you really have to be tactical if you want to outperform the market, right? So when you're looking at each of those indices, you're having a small cap manager, he's managing against the Russell 2000. That's the small cap index. If you're looking at a large cap manager, he's mostly going to be managing against the S&P 500. And if you're looking at a mid-cap manager, probably the Russell 2500, which is all well and good, and you want to compete against your indice. But I think if you look at more of a holistic approach and you get more tactical, not only saying, I want to outperform the stock market, but what's your risk-adjusted return? How much are you leaving in cash when you say that? How much are you leaving in fixed income, which is a less volatile investment and a more, say, safe investment that's throwing off yield? Is it a 70-30? Is it a 50-50? Depending on your demographic and your risk tolerance and your age bracket. But also, I think the blending between the different sectors of the market really come in. If you were overweight technology last year, 100% you're going to underperform the S&P 500. If you look at companies like Meta, I mean, Mark Zuckerberg's personal net worth is down from 130 billion to 30 billion. Stock was down over 60%. These things happen. But I think the way you outperform the market is you see what's performed best over the last 12 months, and you wonder, is that going to continue that trend? Or is there going to be something that's maybe like the old saying, the dog's the Dow, that has been the worst over the last 12 months? And maybe that'll be the best over the next 12 months. So I think that's really when you get into an asset allocation, what it was, how I need to rebalance. And this time of year, I think it's very timely to look at that, especially for tax harvesting, tax loss harvesting, and to see what you think will be the best over the next 12 months. And I think being thematic and being tactical is how you do that. But I'm more of a holistic way, not just competing against one particular indice, because everyone has different risk tolerance.
When are you going to author your own book? You so deserve to, at this point, put all of this into proper context, because hearing you speak and break it down is separate of it being philosophical. It makes sense, even from an investor's perspective, but that's the frame of mind that you want to look for. That's the type of mind you want to look for when trying to pick the right wealth manager, and even when investing with the right person. I remember once, Kyle, I asked you what your philosophy about active versus passive management was. And you might not remember this, but you replied, strategic management, Zen, not passive or active. Strategic achieves equivalent or even better returns at far or lower cost to my clients. And to minimize my costs, you said you use strategic management. You charge no hidden fees, disclose everything, and minimize taxes. So I've kind of looked at the way that you have gone about your business and building your brand, and I've seen that, you know what, you actually have a proven method towards creating wealth for your clients. It's quite phenomenal.
Yeah, I think something that you just mentioned, I think is very important this time of year, because this is the time of year that you want to do tax harvesting, the end of every year. And I know we're on New Year's Eve, so maybe it's a little too late for some people, but the point is, these are things you should think about, especially in the month of December every year, that you're going to have some stocks, some assets in your portfolio that have not done well. And maybe if you don't think they have a good prospect, instead of hoping they come back, you take those tax losses that can offset some of the gains you've had over the last few years. And this is really the thesis of someone like Warren Buffett. When he made a bet, I think it was maybe 10 years ago, he bet every hedge fund manager that he would outperform them over a 10-year period. And not many of the hedge fund managers took the bet. And the reason is because of how hedge funds transact. They have a lot of short-term capital gains. In most places, short-term capital gains are taxed at 50%. Long-term capital gains, where no capital gains, when someone like Mr. Buffett will buy Apple and hold it for 15 years, or buy Coca-Cola and hold it forever, he's going to have a better return. And he's also not charging 2% management fees and 20% of the profits. So I think it's not about what you make. It's really about what you retain. And between management fees, back-end fees, and tax-adjusted returns, these are things you really need to look at. I think that's why for the average investor, a low-cost ETF is not a bad investment for the core part of your portfolio. And where you really want to add value are in the tactical satellites you do around that.
That's a great point. You know, when you look at ETFs and when you look at all the tactical satellites around that, that's going into some more complicated financial talk, which we're going to pick up soon. But everything that you just said put things into perspective in terms of proper planning, proper frame of mind, understanding your market, understanding who you're dealing with and not dealing with, and also looking at your historical curvatures. Kyle, thank you so much for piping in. Any closing thoughts for what people should be thinking to be on their way to financial freedom in 2023? We've had a crazy year. Inflation, soaring prices, bottlenecks, a crazy administration. What are your final thoughts?
I think the only thing I would say is, first of all, I'd like to wish everybody a happy new year and have a great, prosperous new year. But at the same time, when the markets are difficult like they have been in 2022, and everyone thinks that the end is near and the markets will never go back up, if you look at the historic performance of the markets, they do trend higher over time, especially if you're in a nice diversified portfolio. And I wouldn't be surprised if the first quarter is quite tough this year. But I think by the time you look at the end of the year of 2023, I also would not be surprised whatsoever if the 2023 returns are in excess of 10% to the upside in the S&P 500. So with that, Happy New Year. Let's all keep positive and let's try to be prosperous.
Those are awesome closing thoughts. Thank you so much. That was our Business and Buzz segment brought to you by Revere Securities. That was our awesome returning contributor, Kyle Wool, non-executive chairman at Revere Securities. Definitely check them out at reveresecurities.com. You're listening to A Moment of Zen right here on 710 WOR, the voice of New York, iHeartRadio. We'll be right back after this.
A Moment of Zen is brought to you by Revere Securities. Revere is committed to building a relationship of trust in which they work closely with you to help you define your objectives, explore alternatives, and choose the financial and investment strategies that are most appropriate for you. Go to reveresecurities.com.